The S&P 500 surged 2.9% on Tuesday, and oil fell $20 a barrel on the same news. That collision tells you everything about how this rally was built. When the US and Iran announced a 2-week ceasefire, markets priced in a full resolution. But the Strait of Hormuz is still running at 10% of normal capacity. Before the war, roughly 100 tankers moved through that choke point each day. Right now, about 10 ships are cleared to transit. That's not an open strait, it's a trickle. Vice President Vance called the ceasefire fragile in official comments. Oil executives are more specific. United Refining CEO John Katsimitidis said prices could fall another $20 a barrel, but only if shipping fully normalizes. If the strait reopens completely, crude slides back toward 65. If ships stay stalled, every dollar of this rally is borrowed against a risk that hasn't cleared. Markets didn't wait to find out. The VIX dropped 17% in a single session. Goldman Sachs and Caterpillar drove the Dow, both benefiting from reduced geopolitical uncertainty. Meta jumped 8%, partly on ceasefire relief, partly on its own AI news. The question is whether investors have priced in peace or just the announcement of negotiations about peace. Those are not the same thing. That same oil shock that sent markets rallying is now forcing the Federal Reserve into territory it hasn't occupied in years. Cleveland Fed President Beth Hammack said this week that the Fed's next move could be either a cut or a hike. That's not indecision. That's a genuine two-sided trap. Inflation may hit 3.5% in April, the highest reading since 2024, driven almost entirely by energy costs that rose 30% since the war began. The March Fed minutes show officials understood this problem before the ceasefire. A vast majority of participants still expected one rate cut in 2026, but the minutes also noted that a hike had been explicitly discussed if inflation stayed persistently above target. Steve Murin and Christopher Waller voted to cut. The majority held. That split is not resolved by a 2-week truce. The inflation bleeding through to consumers isn't just gas. Fertilizer costs are up. Diesel for food distribution is up. Labor shortages in agriculture, estimated at 42% of the crop workforce unable to work legally, were already pushing produce prices higher before the war. Cornell economist Chris Barrett notes that refrigeration and food processing electricity costs compound at every stage of the supply chain. The war added a 1% to 2% produce price increase on top of pressures that were already building. If the ceasefire holds and energy normalizes, the Fed gets room to cut. If the truce breaks before CPI prints on Friday, the April inflation number becomes a serious problem. The Fed meets April 28th. That's the date to watch. On the same day the broader market rallied, Palantir fell 6.6%. Meta gained 8%. Both are AI companies. The gap between them is the story. Meta launched what it calls Muse Spark, a closed-source large language model built for Facebook, Instagram, and WhatsApp. The move away from open source is deliberate. Meta is now competing directly with OpenAI, rather than giving its technology away. Investors read that as a path to monetizing the billions Meta has already spent on AI infrastructure. Palantir had no such catalyst. Instead, Michael Burry, who made $100 million personally shorting the housing market in 2008, posted on X that Anthropic is eating Palantir's lunch. Burry cited Anthropic's annual recurring revenue jumping from $9 billion to $30 billion, calling it an easier and cheaper solution for enterprise customers. Palantir counters with 70% revenue growth in Q4, its 10th consecutive quarter of accelerating growth. Both facts are true. The market chose Burry's framing on Wednesday. Beneath both stocks is the larger CapEx question. Amazon plans $200 billion in AI infrastructure spending this year. Alphabet is targeting up to $185 billion. The fear on Wall Street is that the returns won't justify the outlay, what analysts are calling the CapEx trap. But Alphabet's 2025 free cash flow actually improved year over year, despite $91 billion in capital spending. Amazon's book value rose from $286 billion to $411 billion over the same period. The evidence so far is that the largest spenders are generating returns. The risk is that smaller players, those without the scale to absorb the costs, are the ones left holding the bill. The weight of evidence leans toward Meta and the mega-cap AI spenders continuing to widen the gap of the pure-play AI software names. That holds as long as closed-source monetization delivers on its promise, and energy costs, which directly affect data center operating budgets, come down with oil. If the ceasefire fractures and energy stays elevated, AI infrastructure margins compress, and the CapEx narrative flips from validation to warning. Watch Meta's Q1 earnings call and the April CPI print on Friday. Those two data points will tell you whether Wednesday's divergence was a signal or a noise.